Welcome to the Broken Pie Chart Podcast, episode 123. I'm your host, Eric Moore, and this week we have a very special guest who's going to tell us a lot about the senior loan market, comparing senior loans to bonds and the high yield space, and just really a lot of really good information. So our guest this week is Dan McMullen. I'll tell you a little bit about Dan, and then we'll get into it. He's the Senior Managing Director and Senior Portfolio Manager in Blackstone Credit's Liquid Credit Strategies unit, also the portfolio manager of the SPDR Blackstone Senior Loan ETF, symbol SRLN. Also, Dan is a member of Blackstone Credit's LCS Management Committee, LCS US Syndicated Credit Investments Committee, Global Structured Investment Committee, and Asset Allocation Committee. Dan, that's a lot of committees. Dan, how are you today?
I'm fantastic. Thanks, Derek.
Dan, thanks so much for coming on. I was really excited to have you on because you've got such good experience in this space, and we've heard in the news. If you read the Wall Street Journal, you look at the news, and everyone's kind of heard of high yield bonds or investment grade bonds, but senior loans are a part of the market. And I think it's been growing, and we've also heard hey, what's collateralized loans? So Dan, thanks so much for coming on today, and I think you're going to add a lot of value.
Happy to be here.
All right. So first off, Dan, tell me, what are senior loans? I mean, we think about the capital structure, and you go back to kind of Finance 101, and everybody knows, well, I shouldn't say everybody, but it's like, okay, bondholders, then you got preferred stockholders, then you got equity holders. But what are senior loans? Where do they sit in that structure?
So senior secured loans are issued typically to non-investment grade companies. And as the name implies, they are senior to all other debt and equity in a company's capital structure. They're secured, so they're similar to the mortgage on your house. So they're secured by the company's property, plant, equipment, trademarks, brand names. That's all collateral. And that security is valuable because should the company default, the lenders receive that security. They're now owners of all of the collateral. And that means that in a default, as if an equity owner might receive nothing in the event of a default, well, the loan is collateralized by all of the assets. So there's usually a higher recovery. And historically, the recovery rate for loans has been 60 to 70 cents on the dollar. High yield bonds, for example, has been 30 to 40 cents on the dollar, and equity is much lower than that. Another aspect of loans and why they're interesting tonight, you're hearing a lot about them in the news, is that they're floating. So the base rate for senior secured loans is LIBOR today. And that is, it's a short-term base rate. It increases when rates increase. So it can act as a hedge against inflation. And so when rates rise, well, your income rises if you're an investor in these loans. So as rates rise, your income that you receive from owning the loan rises. There is a credit component to that, or a credit spread that remains the same. And so many investors are focused on senior secured loans in periods of rising rates or expectations of rising rates, which you see right now. So those are the main differences. High yield bonds, for example, those are junior to senior secured loans. They are unsecured. High yield bonds have call protection. Loans do not have call protection, so they're callable at any time, and that's another main difference. And then finally, with respect to loans, they are the loan market overall. I would say it's about, in the U.S., it's about $1.3 trillion. It's about the same size as the high yield market, also $1.3 trillion. And taken together, that those two categories, or the non-investment grade categories, are about 6% of the 46 trillion U.S. fixed income market. And that includes treasuries, mortgages, and corporates. So senior secured loans are a niche within the entire fixed income category.
With those loans, I mean, we think about bonds, and bonds have a price. Bonds trade either above par at a premium, below par at a discount. Interest rate changes, and we'll kind of get into that later. But are loans on the secondary market, are they priced similar to bonds in that way, Dan?
Yes, loans are very, very similar to high yield bonds. So when a loan is first issued, it's issued by a bank, one of the bigger banks like J.P. Morgan or B of A or Goldman or Morgan Stanley, and the company that's issuing the bonds will do a roadshow. It'll meet its investors, and then you'll have a week to consider the opportunity. And then investors, and there might be, of the investors in the market, there might be 250 different types of investors or groups that invests in loans and bonds, responsible for numerous end market investors. But commitments are made for each loan. You'll receive an allocation shortly thereafter, and then the assets are traded in the secondary market. And so if there's 25 dealers out there making markets, typically the loan is allocated at a small discount. Today it's like 99 and a half or 99 cents on the dollar. It frequently trades up to par, and then it'll trade around par generally in the secondary market. And it'll trade in blocks of 2x2 on a bid-ask spread, or it can be up to, for a bigger loan, up to $50 million on a side on the screen, and it could be bigger than that as well. And high yield bonds are traded much the same way.
And so with bonds, there's either a call date or call provision, right, where it gets called away, or maturity. With senior loans, they, as you said, there's no necessarily call provision because they can get called in at any time. The company can choose to retire the debt, but there is no maturity certainty, right? So it's an investor owning one of these senior loans. They would either have to sell it in the secondary market, or they can just perpetually keep it so long as the company doesn't call it back, right?
Well, that's not exactly true. The loans are, there is a maturity for loans, and the loan maturity is usually 6 or 7 years, or a year shorter, or inside of the high yield bond. And another clarification to make is that many of the same companies that issue high yield bonds also issue loans. So it's very common to see that the loan and bond from the same company. Loans are callable generally. And so what that means is that if a company is generating a lot of free cash flow, which they usually do in our market, companies can use that cash flow to retire their debt or to repay the debt without a call penalty. When a loan is first issued in the current market, there's something called call protection or soft call protection, which just means that the company can't reprice you if its loan trades up significantly, if there's more demand for the loan. Some loans have some call protection, but it's unusual. Nearly every high yield bond that comes to market does have call protection. And so what that means is that if a loan is trading at a discount or premium, but generally investors use a rule of thumb of 3 years. Historically, a loan is outstanding no more than 3 years before it's either priced or refinanced or called, or the company is acquired by somebody else, or they do an IPO, or whatever happens. But the general life of a loan is on average about 3 years.
Got it. No, that's perfect. Thanks for clarifying that. I should have phrased it better. I should have phrased with a little like inflection of my voice at the end, like with a question mark, right? Because I think it's one of the things, right? Senior loans, and I'll probably transition to the difference between a senior loan and a collateralized loan, but they're really close cousins to especially high yield bonds. But let me just ask you now. I mean, I think a couple of years ago there was a lot of articles on the collateralized loan obligations or leverage loans. So, Dan, can you take us through the difference between a senior loan, leverage loan, or CLOs? Just kind of talk through that space a little bit.
Sure. So the short answer is that senior loans and leverage loans are essentially the same thing. It's two names for the same topic. And you'll also hear me refer to senior secured loans. They're generally all the same asset class. CLOs are a little bit different. Blackstone's the largest issuer of CLOs. So what that means is that, we'll manage portfolios of loans, and the equity and the debt. So those portfolios will be leveraged. The leverage is usually 10 to 1, or you'll have a 10% equity component to it. And then the rest of the capital structure, or the rest of the portfolio, will be tranched out. About 75% will be AAAs, and it'll get a rating by Moody's and S&P. And it'll usually go down to the BB level. And then that debt is then sold off to different investors. So loans are actually the underlying loan to a company. But a CLO is a collateralized loan obligation fund. All that really means is it's a portfolio of senior secured loans. It might be 250 or 300 different loans. And that is a leverage structure.
So you mentioned earlier that these are collateralized loans. So plant property equipment, things like that. So, I think about somebody owns a building and they go into default or go into bankruptcy. But the people in bankruptcy get the asset, they can sell it off, right? But that includes intellectual properties and patents as well, right?
That's correct. So some of the brand names or some examples of companies I mentioned earlier, like Dell Computer or Bosch and Lohm or NASCAR, Formula One, American Airlines, United Airlines, Delta, Michael Stores, HCA, iHeart. I mean, those are very valuable brand names. And usually in a bankruptcy, the loans will continue trading in the secondary market right up to bankruptcy, but they'll also continue trading through bankruptcy. So just because a company files for bankruptcy doesn't mean that the loans stop trading in the secondary market. So if that happens, then at any point in time, if an investor doesn't want to own a loan that's in bankruptcy or a loan to a company in bankruptcy, they can easily sell it in the secondary market.
Thinking about the bankruptcy process, and I'll make a silly reference, right? But the way when I first started learning about loans and about the debt markets is, look, I've got a loan on a company that sells fishing rods, and so they go into bankruptcy. I own a bunch of fishing rods, and I got to go sell them, and hopefully I get. I'm probably not going to get full value for those because I got a bunch of rods, and everyone knows I got to sell them, right? But can you just kind of explain the process from maybe the senior loan perspective? Company goes into bankruptcy. What happens? Am I making is my silly little example spot on, or is it way off?
No, look, I think you're absolutely right, and it really depends on how big of a loan we're talking about, right? So if we're talking a loan, and most of the loans, and we're talking about the broadly syndicated loan market that we trade in, those generally have a tranche size of $150 to $200 million minimum, and many of the loans in our market are $2 billion tranches or $4 billion tranches. So these are very large liquid loans. In that scenario, you probably won't end up with a bunch of fishing rods that you need to sell. Like I said, you're going to be able to trade that debt in a secondary market with another investor, probably a distressed investor. There will be a bank or a dealer making a market both to buy and to sell, and you'll negotiate your price in the secondary market on a regular way basis. If it is a smaller loan, you might certainly end up with a bunch of fishing rods or whatever other collateral that the company posted as collateral that you lend money to. It's just bigger companies.
No, that makes sense. And I suppose if it's let me ask you this too. I mean, the types of companies that use maybe a senior loan versus a bond? Is it timing, like a company only needs the money for a certain amount of time, or is it just it's cheaper to go to the senior loan rate? I mean, maybe talk through the types of companies or why they would use those versus some other instrument. Obviously bonds is the close cousin here, but maybe just explain that relationship.
Sure. So maybe the easiest way to think about it is that the main borrowers of senior secured loans and high yield bonds are non-investment grade companies. So that means they're rated below triple B. If they're rated above triple B, they can easily go tap the investment grade bond market, or they can get commercial paper, or they can get other lines of credit, which are far cheaper than our market. In our market, generally loans come about when there's M&A activity. One company wants to buy another company, or maybe one company wants to do a dividend to its investors, or maybe a company has to refinance its existing debt, or maybe there's a private equity sponsor involved and they want to buy a company. So they buy a company and they'll issue both loans and high yield bonds. An interesting caveat is that the investment grade bonds I mentioned before are unsecured. The high yield bonds are unsecured. So only the senior secured loans have that security, that valuable collateral package. And many of the same companies, like Adele, Bausch and Lomb, American Airlines, or Michael Stores, or some of these companies, they'll issue both bonds and loans because they're raising a lot of debt, and what they'll find is that the loan is cheaper than the high yield bonds, but the loans they have to post collateral, and they generally have more covenants or lender protections than the unsecured high yield bonds. So that's the main difference. Loans are cheaper from the borrower's perspective than high yield. High yield also has that call protection I mentioned before. So high yield will have a non-call period of, call it 3 years, depending on the tenor. And so that means that the company cannot repay that bond. So sometimes it's to the company's benefit to repay its debt or reduce its debt at a low or no cost if it's generating a lot of free cash flow. And so in that case, they would choose the senior secured loan.
You mentioned covenants, and I think it's an interesting topic to delve into. Normally we think, if I was going to loan a friend of mine money, I would say, what's the likelihood that this person would call me back? There'd be a term, we'd agree to an interest rate. But a covenant in some ways says, hey, Dan, I'm going to loan you money, but you can't do X, Y, and Z. So broadly, covenants, what type of limits do they put? How much control do investors have on a company taking money from them in the way they run their business? Maybe talk about that a little bit.
I think that's a great point. Senior secured loans have much, much more extensive covenant packages than unsecured high yield bonds. They will have things that limit or incurrence tests, and generally covenants are something that you read about a lot in the financial newspapers over the last few years. But there'll be limitations on minimum amounts of cash flow or EBITDA a company can produce. And if a company's cash flow starts to decline or its performance starts to deteriorate, the lenders can get the company back to the table and renegotiate the terms of that loan. So if they see the company is going through a down cycle and they need a little bit more flexibility, or let's say they need some liquidity, they can negotiate to get a higher coupon or a higher rate, or maybe they'll negotiate for some more amortization. And amortization is a common theme in senior secured loans as opposed to high yield bonds. And so like those covenants, and there's also restrictions on minimum amounts of debt that they can incur, minimum amounts of dividends that the company can make, minimum amounts of acquisitions that they might be thinking about making. And the whole concept behind it is that your loan to that company will never be worse off over the tenor of your loan. It's a lot like the covenants or the packages associated with a mortgage on a house. You have limits on what you can do, on how much debt you can incur, on certain things that you can do with your home. Well, it's the same way with these financial covenants in the loan documentation.
Dan, are there, in bonds, I think Tesla is an example I can think of, and I'm recalling this in my head as we're speaking, but there were some convertible bonds where they converted into equity shares, right? Is that something that's sometimes attached on the senior loan side as well?
It's possible. It's not common at all.
Not
Generally,
likely.
that's not
Okay.
the case. I mean, like there was one high-profile example of that last year, but not. It's really unusual in a performing credit.
Got it. So we think about, you mentioned one of the advantages for the end company could be a lower cost of capital, lower interest rate they have to pay. You did mention it's floating. For a lot of years, LIBOR was sort of the standard, right? And LIBOR was, basically, there were some challenges with that. How's that, Dan? I'll put it that way. there was a Google LIBOR, and you'll find all sorts of things. But now we're talking about SOFR, the secured overnight funding rate. And then there's also, I think Bloomberg is coming up with an index. So the loans, what are they generally based upon now? And my follow-up is probably going to be, what do we think of SOFR versus something else? And so it's still primarily based on LIBOR. Is it transitioning more? How does that work, Dan?
Well, the nuance to that is that, today is LIBOR, but because LIBOR is so low at, 15 or 20 basis points, most loans are based on a LIBOR floor. And the LIBOR floor is 75 to 100 basis points. And so typically you have this 75 or 100 basis point floor, and then you have a credit spread on top of that. And to the extent that LIBOR increases above this floor, well, then LIBOR starts to matter. Not all loans, higher quality double B loans probably don't have floors, but single B loans and maybe some lower loans will have LIBOR floors, and that's just a function of the low LIBOR environment we're in post March of 2020. But going forward, you're right. There is a move to the base rate for various reasons to something different than LIBOR, and that's really just a function of the methodology that's LIBOR that's used to create what that standardized LIBOR rate is.
Yeah, I think I had, when I think about the floor, maybe this is a good example. I had a loan that was based, it reset every couple of years. And it was basically the yield on the continuous 5-year maturity, treasury bond. But the floor was 200 basis points. So it was always like 200 basis points plus whatever the rate is. But there was a rate it couldn't go under. I think it was 200 basis points or something like that. So like when my loan came up for repricing, I didn't get a 50 basis point, 0.5% loan, 0.5% loan. It was like 2.5. So it's kind of similar, right?
Yeah, that's right. And really, you only think about loans that have LIBOR floors or the LIBOR floor concept in periods where LIBOR dips below 1%. And all that really means is that if, when a loan is around 1% or below 1%, then it becomes hard for new issuers to access the credit markets if they don't put a LIBOR floor in there. And so the repayment rate for the loan market, it might be 30% of the entire $1.3 trillion market a year. I mentioned that most loans have a 3-year repayment period. So you're constantly getting repayments as these companies refinance or take dividends or go through their normal activities. You're constantly participating in the primary market. And so you're constantly trading these loans through your portfolios. And so I'll give you an example. So today there's been about 175 billion of issuance of net new issuance of senior secured loans this year. JP Morgan just put out a report that said they thought that number was going to go to 265 by the end of the year. So that means it's 90 more to go. And I think it's going to be above that. And so the supply of the net new loans coming to market is very strong. So there's a lot of choices out there. And that's good for the lender, right? We have a lot of choices of different types of loans that we can lend to, different structures, different yields. So it's all it's in our favor. It's a really robust, balanced market at the moment. But back to the SOFR, LIBOR, it's not really clear what is going to work in our market. Many of the credit agreements that are coming to market now have contingency plans. So, if we switch to SOFR, then, it will be adopted. If it's BSBY, that will be adopted. There is drawbacks to the SOFR and some solutions to it. But right now the component or the main concern is the lack of a term premium or how might that base rate change during periods of volatility. But because LIBOR is so low at 20 basis points compared to SOFR, they're very close. There's no real impact on price if we switch to it, or very minimal impact on price if we switch to SOFR today. It's just, we have, I believe we have 2 years to figure it out. So sometime in the next few years, we'll have more clarity on what the ultimate base rate will be.
We'll know when we know, in other words, for lack of a better way of saying it. But yeah, and it's these senior loans too, when I think about the interest rate that's most applicable to them, it's at the very, very short end of the curve for sure. And we've seen, we've certainly seen very low rates for, 2008, right? That's when essentially we've been below even the inflation rate for a long time. Dan, what are the impacts though, and of interest rate changes the easy one to say, okay, well, if interest rates go up, companies' cost of capital goes up, their interest charge, the amount they're paying on loans. But just broadly, and maybe if you have a little more narrow view on how interest rate changes affect these companies, not only that, but just the use of senior loans.
Yeah, I think that's a good question, and that also, you've highlighted on what happens when rates increase and the impact, and I think it's important to highlight that loans typically have a base rate of LIBOR, but the LIBOR component that's most commonly used today is 1 month LIBOR, and a company can choose between 1 month LIBOR or 3 month LIBOR, and it depends on their forward view of rates. But for 1 month LIBOR, there's no duration to that loan because they are resetting their base rate every 30 days. And in the current environment, even though the treasuries have backed up, 1.5% today, and people think it's going to go to 2%, the short end hasn't moved at all. And so it really depends on your view of the rate environment in the out years. So what I would say is that you could have Fed rate increases over the next few years that are projected to happen according to dot plots, but a company's interest expense might not increase at all, because if a lot of it is floating rate, then it's keying off 1 month LIBOR, which it's very low now, probably doesn't increase anytime soon for a while, and so as a result, they won't have any change at all, and so it will continue to be a very issuer-friendly environment relative to interest costs.
I also think about, a company when they go to the markets, and there's been a few high-profile ones, like GameStop and AMC, that their price has gone up. They've issued shares. I use those as an example because they've been in the news. Kind of irrelevant to our conversation, though. But companies can issue shares. We know the downside there is it dilutes the existing shareholders, right? At least that's Finance 101. And so, I mean, it seems like part of the reason why, and this is me saying this, right? But I'm asking the question. It's the cost of capital has been so low with interest rates being so low. Like these companies, it's just to raise capital. I'm sort of smiling and sarcastically saying, why wouldn't they go to the loan market as opposed to issuing shares? I mean, how much of a function are you seeing with that at all? Um, or is it just, look, it's the answer's right in front of you. It's just Finance 101, right?
These companies, they're not investment grade.
That's right.
And it
You've said
really,
that. Yeah, you've
and
said
so
that. Yeah.
there's risk to these companies. Like there is true, um, there is true fundamental credit analysis that goes into our investment decisions. And we have investment committees that meet twice a day. Every credit that we own must be approved unanimously in our investment committee. And we do a lot of due diligence and detailed analysis on every single credit. So, and in fact, our approval rate might only be 50% as we think about credits in our investment. So we're turning down half of everything that comes to market. We're seeing just about everything, and so we're pretty picky. And really, in our market, it's really a function of how do we minimize principal loss? How do we not make mistakes? Because loans have an asymmetric return profile. They only, if you do all of your analysis and you're right, well, you're just going to get par back, right? But if you're wrong, you could lose 30 or 40% of your principal. And so our goal is to minimize or mitigate downside risk. And so not just anybody can issue loans in our market. It's got to be a strong credit. They have to generally have strong free cash flow. They might be a market leader or a top three in their market category or in their segment. They have to have real barriers to entry. They have to have strong management teams. Those are just some of the examples that we look at. And so that might be lending 101, but it is, it's not just quite as easy as anybody can show up to the market to sell debt. And it is a function of, leverage, loan to value, and also where are their comps trading and what does that look like?
You bring up an important point, which is the risk, right? And that's always front and center, should be front and center for not only institutional investors, but individual investors. Can you talk about sort of, the risk here is a company defaults, right? And you wind up with the fishing rods. I say that, I'm smiling as I say that, but, do you have any, historically, what are sort of default rates in the space, or are there other risks besides default? I mean, that seems to me the most prescient one. We just talk about defaults in general.
Sure. Historically, long-term defaults for loans is around 3%. High yield bonds, I think now is closer to 3.5% or 4% now. Going back over the long term, and recoveries in the event of a default typically are 60 to 70 cents on the dollar for loans because they're secured. For unsecured high yield bonds, they've been 30 to 40%. Last year, for example, 2020, the default rate for loans was 4.5%. So it peaked. High yield bonds peaked at about 6.5%. Going into this year, JP Morgan, for example, and I'll use them as their strategies just published an updated mid-year outlook. But they had the default rate at the start of this year at 2.5% for both loans and bonds. They recently took that down to 65 basis points for loans and 1.5% for bonds. And the reason is because there's companies are doing really well. Companies have rebounded. There's been very strong performance from companies across the sector in general. I tell you that it's driven by strong GDP growth, strong anticipated GDP growth over the next few quarters. We're seeing unprecedented fiscal stimulus as a percentage of GDP. Currently, it's around 37% of GDP. So for the U.S., we haven't seen that since World War II. That doesn't include incremental stimulus that may come from the president's infrastructure proposal, which might result in incremental spending. So you have the GDP, the fiscal stimulus. You have the reopening from the rollout of the vaccines, and the COVID cases are going down in the U.S. And so all of that taken together is very, very strong growth. And the way that I think about it personally is that the default cycle has effectively been reset, similar to where it was in 2010. So if you remember, after the financial crisis, we went through a period where the worst companies defaulted, those companies that didn't have liquidity or couldn't refinance their debt. And then after that, you had a period of very low defaults where companies had very strong growth. And it was a very good time to invest in the unsecured credit markets. Today, it's very similar to that. We do not see that many defaults on the horizon. That's for sure. And what the other component of that is we're seeing very strong upgrade to downgrade ratios. So the current upgrade to downgrade ratio is at a record 1.9 to 1. We've never seen that strong of an upgrade cycle. And so we think that probably continues. And I think that part of the reason for that is that the rating agencies were aggressive in downgrading assets ahead of or going into COVID last April, May period. And now they're sort of waiting to upgrade those companies. Many of those companies, their leverage increased because their EBITDA declined, but as they anniversary their cash flow, they'll have better leverage ratios, and they're delevering. And once the rating agencies receive financials, they'll be able to upgrade the company. So like all of those things taken together, it's a very good environment for the senior secured loan market.
What you were saying there is interesting, and somebody had passed me something from Bloomberg recently, and it was in high yield zombie net debt has dropped to its lowest level since 2009, which surprised me. And of course, zombies, zombie companies, right? And Marcel talked about this. I guess it's about a month ago. I'll post a link to that. But where your income isn't sufficient enough to pay the interest on your high yield debt. But I was surprised by that, to see that zombies have come down, and what you were just saying seems to support that.
The example you gave before about the capital markets being wide open, it resonates to that point. If a company right now needs runway, it has access to capital. Maybe it's debt, maybe it's equity, but it's available. And it is another statistic along those lines is, and I saw it was this week, the CCC index of the high yield market is at its lowest yield ever. It's under 8.25%. And so it's never been down there before. And so like the distressed category is very, very low at the moment.
Could you, as an aside, by the way, I don't know, I've been doing this, I guess, for 27 years now or something like that. And the idea that high yield, on average, and I'm kind of making a blanket statement, is getting close to a negative real yield. I mean, it seems it's interesting. Let's just put it that way. Of course, inflation could come back down, but actually, I did want to ask another question about just the loan market in general. One of the things that we always look at, right, is liquidity. And when we think about liquidity, it's how easy can something be traded, or how much of a haircut do you need to take in a liquid market? So just on liquidity in general, right? So how liquid is the market? What happens to these types of loans during times of distress? Just kind of talk about that.
Sure. I think that the loan market is just as liquid, if not more liquid, in most times than the high yield bond market. For reference, it's a function of the size of the tranche sizes. So the larger the loan size, the more liquid it is. The more investors that will own the loan that might participate in the market. I think that during periods of stress, certainly we found in November of 18, in March of 2020, back in when we were managing portfolios in 2007, we always found liquidity in the loan market. It would just be at a lower price. And if you wanted to compare that to high yield, well, if a loan dropped in price from par to 90 cents on the dollar, the high yield bond in that same capital structure from the same company might be lower at price to 80 cents on the dollar or 85. So high yield would be lower because it's junior in the capital structure. But we found very good liquidity through those periods.
Got it. Yeah, and the other thing, I have a couple, so I'll hit you with some quick ones too. Just thinking about, someone who's looking at, doesn't matter what company, but they're pulling up the financials. So senior loans, you're going to see the effect of those. That will be, I imagine, short-term, debt less than a year, correct, on the balance sheet.
Well, actually, it depends on the maturity, but most times, most times loans are long-term debt. So they do have, they do have a maturity of 7 years when they're issued. So as a result, they're long-term debt. They might have some sort of amortization, but most institutional tranches, it's only a 1% per year amortization. So as a result, for the most part, it's long-term debt in a company's capital structure.
Okay, so explain, when you think about amortization, explain for my listeners, right? We think about a mortgage and you've got an amortization schedule where, a lot of your loan is interest in the beginning, less, paying off your equity, or a home equity loan, which is just interest for the amount, the term. So you mentioned amortization. Can you kind of explain that, how that works for senior loans?
Sure, it's similar, but much more simpler than the amortization on a home mortgage. That's for sure. Generally, it's only about 1% of the principal amortizes per year, and then it is a bullet where the majority is due at the end of the 7 years if it's a 7-year maturity, and that's for large liquid loans. That's normally what you see in the market today.
Is it similar to where, a lot of companies, right, bonds come to maturity and they reissue new bonds to pay off the old bonds, right? They don't really want to retire the debt. Is that similar to what happens in the senior loan market, or is that not the case?
It is similar. The main difference is that generally these companies generate so much free cash flow that they don't have alternative uses of that cash. So what they will do is they'll just repay the loan to reduce their debt. I'll give you an example. So when we look at a typical company when it comes to market, one of the metrics that we look at, among others, is the free cash flow as a percent of total debt. The total debt is going to include secured debt, unsecured. The loan to value might be 50%. And so we kind of want that free cash flow, which is EBITDA less interest, taxes, free cash, working capital, and amortizations, to be about 10% of total debt. So the company is throwing off 10% of its outstanding debt each year in free cash flow that, they're either going to, repay their debt, or they're going to, maybe they do a dividend, or maybe they go use that cash to go buy a competitor. So those are their options. And if they don't think that, any of those options are interesting, many times what they do is they just look to reduce their debt. What they might do is that in this environment, if they issued a loan in April or May of 2020 when rates were higher, maybe they weren't sure of their access to capital, maybe now they want to repay that, or maybe reprice it. So, like on the mortgage of your house, if your rates are lower today than they were when you bought the house, well, then what you might do is refinance your mortgage at a lower rate. Well, companies do the same thing. So they've been very active in refinancing their existing capital structures.
You mentioned that one of the advantages is that they have soft call protection, but companies are able to retire the senior loan debt a little bit easier than you said, that 2 or 3 year period. One of the things that comes to mind is, there were a lot of industries when in the midst of the worst of COVID, right, the lockdowns, let's say, last year, I'm just thinking, if I owned a cruise line and I had to go to the equity, the debt markets, they'd say, okay, but here's your rate. So I see what you're saying. I mean, it's almost like a mortgage. And mortgage rates drop. There are opportunities for companies to improve upon the rate that they're paying, right?
It's very similar. And a lot of the companies that you mentioned, some of those companies that were most impacted by COVID and COVID restrictions, like airlines and theaters and leisure and cruise companies, many of them never really had that much secured debt. And so they looked around and they said, we have to raise debt, so we've got collateral. And so they tapped our market. And many of them also issued secured high yield bonds, which is unusual too. But we saw record issuance of secured bonds last year. And the reason is if you put collateral, well, you're going to be able to entice more people to lend money to you.
Right. So the cruise line has all these ships, these big, huge ships, and they say, we'll put those up, and if we can't pay you, you're the proud owner of a ship, right? So kind of how it works. I want to ask you too, Dan, about you mentioned earlier, you touched on, there is M&A in spaces. So are there times, what happens? Maybe you own a loan on a company that winds up being acquired or winds up doing a merger or some sort of M&A. Kind of what happens to those, and are there any interesting advantages or disadvantages that a senior loan investor has in those instances?
Well, that's sort of like the life of the loan. You have a loan and it's issued by a private equity company who buys a company. You do a lot of research. You buy the loan, you own it. It pays you interest. Everything works out. You monitor it. You can trade it at any point in time. You might buy more. You might sell some. If you think that it's going to continue to perform very well based on the next quarter's earnings, maybe it trades up. Maybe you buy a little bit more. If it trades off on market weakness like the COVID crisis and trades down to the low to mid 90s, you might buy more and then benefit when it trades back up. So, and at some point, I mentioned that there's a maturity of 7 years on these loans. Like what happens is that they're going to get repaid. The credit agreement has something called a change of control generally. And what that means is that if a company that a private equity sponsor bought, maybe they sell it to somebody else, maybe they sell it to a corporate, maybe they do an IPO, that loan is repaid at par. I mentioned that loans are typically callable at par or repayable at par. So as a result, the loan market typically doesn't trade up above par that much. Maybe 101 because there's limited call protection, because you don't want to pay 102 for a loan that only pays 6% interest, only to find out a few months later you got repaid at par because you just lost 2%. And so all that means is that you will have constant repayment. When a loan is repaid at par, you get your money back as an investor, and you go buy something else in the primary or the secondary market.
Dan, this has been really good. It's I feel like anyone listening to this gets a really good education on the senior loan market, and I think it's an area of the market that is not focused on as much. Like we don't watch CNBC or Bloomberg TV or Fox Business. You don't have a lot of people talking about showing examples of senior loans and things like that. So I think this has been great, and I will put a link to the one of the products that you're involved with in the show notes. So if anybody wants to check that out, and I'll also put some links to some prior episodes as well. Oh, by the way, I had this written down. Somebody said, "Hey, ask him a really dumb question." So I'm going to ask it, and that's the interest that's paid on the companies pay on their senior loans. That just gets lumped in on the income statement or the cash flow statement, right? With everything, all the other interest they're paying, or does it?
Absolutely, yes.
So that one it does. Perfect. I almost forgot to ask you that. That's the thing. I'm more than willing to ask questions that are easy questions or dumb questions, because I think people in the audience have it, and I'd be doing them a disservice by not asking it. So, Dan, thanks again for coming on. You've got great experience in the space. Again, I'll link to your stuff below, and can't thank you enough, Dan. Hopefully, at some point we can have you back on.
Great, it's been a pleasure. Thank you very much.